Say you're a newbie investor who happens to know somebody who owns investment property, and let's say that person is looking to sell their investment property. Can you structure a 1031 capital gains tax deferred exchange whereby that person you know sells their property, uses the untaxed profits, and reinvests them into your first property so that you can acquire a property and then cut them out of the deal later on because they just want the money, not any investment in your new property? It's an interesting question. Time for some Q&A. Welcome back to Confident Real Estate. I'm your host, JC. Today's question comes to us from Rich. It's an interesting question, but before we get into it, I think it's important that we at least summarize what a 1031 capital gains tax deferred exchange actually is. Under the Internal Revenue Code, Section 1031, don't fall asleep. I know I just said something that sounded boring. Stay with me. Under Section 1031, you can do a like-kind tax deferred exchange. You can sell a property and then you can reinvest the profits of that sold property into a replacement property within a certain set of time frames. There are different structures to how it needs to be done. There's a whole nother video we just did that covers all this, so click the link above if you want to check that out. And then come back and check out this video so you have a better understanding. So, 1031 exchange. What is it? In summary, you sell your property, you find a replacement property, you meet certain time deadlines in order to acquire the replacement property, first identify the replacement property and then acquire the replacement property. And if you do so, you don't have to pay any capital gains taxes on the profits you just received from the sale of your prior property. Now, it's not a capital gains tax forgiveness, it is a gains tax deferment, meaning if at some point you sell the replacement property without buying yet another subsequent replacement property with those same funds plus the additional profits you made on the sale of your first replacement property, well then Uncle Sam's going to come and want to get his piece of the pie. So the tax deferment will have ended at that point and you will owe capital gains taxes going all the way back to that first piece of property that you sold. This is what builds real estate investments. This is what encourages real estate investments. There's a lot of talk about ending 1031 exchanges, that potentially they're unfair advantages for people to get wealthy. My personal opinion is that it encourages people to reinvest their money into real estate, to fix it up, to rent it, to keep communities beautiful and in good standing. That's a topic and an argument for another day. So, let's delve into Rich's question. So Rich comes to us saying that he has been looking for an investment property to make his first acquisition in his investment portfolio. Now, he knows somebody who bought an investment property. It was actually their home, and then they moved out and bought a new home that's their primary residence now. And for about 2 years or so, they've been renting out their prior home as an investment property to renters. They weren't fully into it. They had some bad tenant experiences, and now they want to get out of it altogether. They have no interest in real estate investments or any portfolio. They want to sell this property, get their money out, and move on with their lives. However, Rich is trying to convince his friend that perhaps he should use the money from the sale of his property, because it has gone up in value, to invest in Rich's first property, because Rich is looking to build a real estate investment portfolio. The issue here is, can he convince his friend to do a 1031 capital gains tax deferred exchange, again, meaning his friend will not pay any capital gains taxes on the profits from the sale of his original investment property, and then take that money and put it into Rich's first acquisition, capital gains tax-free. Here's the problem. In order to do so, the person investing the money from the original property into the replacement property needs to be on the deed. The money has to follow the person. Again, it's not a capital gains tax forgiveness, it is a deferment, meaning if at any point the investment is no longer being made of that money and it's been pulled out, then it no longer qualifies for the deferment, and you have to pay capital gains taxes going all the way back to the original sale of the original property that the money was invested into. So, in theory, you could, and many investors do this, you buy property A, you sell it for a profit. You buy property B with the profits from property A, doing a 1031 exchange, meaning no capital gains taxes are paid. You subsequently buy property C after selling property B. Again, you've made a profit from property B and you are not paying any capital gains taxes on that profit. Now you sell property C and you buy property D, again with additional profits you've made from selling property C. So here's the issue. If you then sell property D, you could owe capital gains taxes going all the way back to property A. That could be quite sizable. The money has to follow the person making the investment, or the entity, if it's under an LLC, that's making the investment. Here, in Rich's case, it is his friend who's making the investment, and he wants nothing to do with rental property. Rich's idea was to convince his friend to sell his investment property, invest in Rich's first acquisition, and then Rich would refinance that property and pay out his friend. But to do so, his friend would have to be removed from the deed. Otherwise, Rich will have paid him back and his friend will remain on the deed. And that might be okay. I don't know the specifics of their friendship and what his friend's willing to work out. Maybe that's part of the deal for allowing Rich to use his friend's money in order to get the down payment for this initial property. But if his friend is removed from the deed, he no longer qualifies for the tax deferment, and now his friend will have to pay those capital gains taxes. So he will have gone through this whole process and invested in Rich's first property, and at the end of the day, all it did was prolong how long it would take him to get his cash in hand and pay Uncle Sam those taxes that he was owed. I hope this wasn't too confusing and convoluted. Section 1031 capital gains tax deferred exchanges are not that complicated, but the jargon involved could put you to sleep. So I hope you stayed awake through this whole short video. Again, if you want more information about 1031 exchanges, because they are an incredible way to continue building your portfolio growth and your personal wealth, click the link above for the video we did to cover Section 1031 deferred tax exchanges. Again, we appreciate you watching. Hit the like button and hit the subscribe button while you're at it so that you don't miss our future content. I have a feeling that if you don't know anything about Section 1031 exchanges, you're going to have gotten something out of this that may send you on the road to learning more about Section 1031 exchanges, perhaps checking out that video we just did that I just mentioned again. And then you'll be coming back to this video to understand in further detail exactly what Rich was trying to do and why it might not necessarily work, because his friend would have to stay on the deed. And again, that may be something he's willing to do, keep his friend on the deed and pay him back all of his money in order to get the exchange and benefit of his friend putting the money down as the down payment for Rich's initial investment in real estate. Always things to consider, always negotiations to be made. Again, we appreciate it. Hit subscribe, hit like, and we'll see you next time.